I wanted to take a few minutes today to give you a little start on your Chapter 10 homework. I want to walk you through two different types of problems, and hopefully that'll get you headed in the right path. So the first one I want to walk you through is number 4, and this is 10.1 in your book if you want to follow along from the book. And it's just asking for a couple of journal entries regarding your notes payable. So we just have to go through and write these journal entries for these 5 dates. So we'll just start with that first date of July 1st. We borrow $50,000 from First National Bank. This is going to cause a debit to cash. We're getting cash, a credit to our notes payable. And that's for that $50,000. The second one is on November 1st. We're borrowing $60,000. The journal entries don't change, the accounts don't change. But here we're borrowing $60,000. That's the easy part. Now on December 31st, we have to record those adjusting journal entries. This is a great review for that final exam that's coming up. We have to make sure that all of our expenses are up to date before the end of the year. In your homework, they want you to do this separately. So first we're going to record that First National Bank interest. So we debit interest expense. And we're going to credit our interest payable because we're not actually paying it yet. And now we have to calculate the amount. So we take our principal, which is $50,000 for First National Bank, multiply that by the amount of our interest rate, which was 8%. And then we only look at how many months it's been since that July 1st date. It's been 6 months. So from July through December, I calculate that, and it's $2,000. All right, so the second part, we can't forget that second note that we took out. The accounts are going to be the same, interest expense, and credit our interest payable. But now we're calculating the interest on that $60,000 note. Our interest rate is 6%. And since we took this out in November, it's just November and December. So that is a 2-month time frame. So that's $600. All right, now on February 1st, we pay the principal and interest for that Lyon County. So we're looking at this notes payable here. We've already recorded some interest for it, which is right here. So we're going to go ahead and make sure that we first journalize that piece of this. We're going to debit our notes payable because that's going to get rid of that note. We're going to debit that interest payable for the $600 because remember these two relate to each other. We still owe some more interest on that, so we're going to debit our interest expense. And this is going to be for the 1 month because we already recorded through December. We just have to record through January. So that's going to be the $60,000 times the 6% times 1/12, which is 300. And then finally, we're going to include a credit to cash because we have to pay all of this. We're just going to add up everything we just debited, because remember, debits have to equal credits, 60,900. And then finally, on April 1st, we're going to pay off that First National Bank. So we're looking at that 50,000, that first journal entry that we did. Oops, sorry about that. Just trying to scooch this up so give us a little bit more space. And we're going to first debit that notes payable. You're going to look back at how much you owed for First National Bank. In this problem, it was 50,000. We're going to record that we're going to pay off that interest payable. And I can look back and see how much that was. It's right there. It's that 2,000. Now I still need to calculate the interest expense from January, February, and March. So to do that, I would take that 50,000. Remember here, our interest rate is 8%, and I'm looking at 3 months from January, February, and March. So it's $1,000. And finally, got to pay it all off. That requires a credit to cash for 53,000. Make sure your debits equal your credits. So that's just a little review of that notes payable, interest payable. Let's look at one more with bonds. I want to look at number 11, I think it is. Yes. This gives us a good example of how to record each of those bonds. So let me first get there. And I know we have different numbers, but the journal entries themselves are going to be similar, and you can just follow those numbers and do your own calculations. So again, we just need these 3 journal entries. That's all we're looking at. But it gives you a good example of one bond sold at face value, one at a premium, and one at a discount. So that first one on January 1st, we're selling that bond. To sell a bond, you get cash. You record a bond payable, that liability, and that's for $1 million. Because we sold 1,000 8% 5-year bonds at $1,000 a piece. That's how I got that $1 million. All right, and then on July 1st, we're selling $900,000 9% 5-year bonds, and they're selling at 102. So what that means is, you know, they're selling more than your face value. So we need to calculate the amount that they're selling for. And to do that, we take that 900,000 and we just multiply it by that 1.02, and we get 918. So when we record that journal entry, we record our cash, but we get 918,000 in cash. We're going to record a credit to our bonds payable, and that's always for the face value of the bond. And then the difference, because our debits have to equal our credits, goes to premium on bond payable, and that's for the difference of 18,000. All right, last one is on September 1st. On September 1st, we have $400,000 bonds, 7%. and they're selling at 98. Again, that's considered 98% of their face value. We're going to debit our cash. We have to figure out how much that bond was actually, how much cash was received, our cash proceeds. So we take the face value of the bond and times that by 0.98, which is going to give us 392. So the cash you receive is that amount. Again, I'm going to skip a line here. You're going to credit that bonds payable, and that's for the full amount of face value. And the difference here is going to be a debit because my debits have to equal my credits. And this is to your discount on bonds payable for the difference, which is $8,000. So hopefully that gets you started. A lot of journal entries in this homework, but hopefully the repetition will help it sink in. And if you have any problems, just send me a quick email. Thanks.